Welcome everybody to our webinar Inside Private Credit. My name is Kerstin Kubanek. I am Senior Reporter at LevFin Insights. And we're going to cover private credit today. And yeah, if you had asked me 8-9 years ago, what is private credit? The answer would have been very, very simple. Corporate lending, everything that banks do not want to finance. That's private credit. It's the mid-market, it's private equity fund managers who need some financing for their portfolio companies. That's private credit. It has changed over the years, and I'm going to talk about how it has changed and how it develops and what to expect in the next few years. What we will not cover is things like retail, private credit retail, evergreen funds, liquid funds or semi-liquid products, because that's a whole different universe and it's a whole different animal basically. And I will focus on the illiquid part of the space and focus on what we see in the institutional investor-focused segment of the market. Now, let's have a quick look into what is private credit, the basics of private credit, if you will. Now, as I said before, private credit is non-bank lending. Pretty much everything that the banks do not cover in corporate lending, and a little bit more, that's the private credit space, so to speak. It is a highly illiquid market. And I say this with hopefully a little bit of enthusiasm, because I think that this is a very, very important part of the business. And it's important to understand that private credit really is illiquid as opposed to the broadly syndicated market or the high yield bond market. There is no active secondary market, although we will touch the private credit secondaries as well in this webinar. Now, another component of private credit is that we have bilateral contracts in place here. We have a lender and we have a borrower. We don't have a bank as an intermediary, right? So it's a bilateral contract between two parties. And usually the borrowers are sub-investment grade or no, non-rated at all. It's the broad mid-market, so to speak. The lenders are typically private credit fund managers. Now, you can say that banks also have private credit units, which is correct, but those are usually also funds that they raised separately to their balance sheet business. So overall, you can say that it's private credit fund managers that do provide those loans, basically. Private credit has different strategies as well. So the most important one, the biggest one that we will focus mainly on here is the direct lending space. Direct loans to corporates, senior loans or also junior loans. We also have capital solutions, which is also an important part in the private credit space. Distressed debt, also a huge part. Asset-based financing, including NAV financing, net asset value financing, etc. Now, the main focus, who are basically the target companies for private credit, especially over here in Europe, the main focus is mid-market companies with an EBITDA of 15 to 75 million euros. And in direct lending, the structures that we see most of the time is the classic unitranche. The classic unitranche, this can be a senior, a very, very plain vanilla stretched senior that's very, very similar to the term loan B that you can see in the broadly syndicated market, or junior structures as well, like a PIK, payment in kind structure, or preferred equity as well, also counts as junior debt. And you can have a combination of both because it's unitranche for a reason. You have a unitranche that can consists of different facilities, a senior and a junior part. Now, how big is the market? There are currently around 500 private credit fund managers that are active overall in Europe, which is, of course, a lot. They differ in size. You have very large ones, you have tiny ones, of course. And just to give you a few names that you probably heard of, we have Ares, we have Arcmont, Blackstone, CVC, Hayfin, etc., just to name a few of these fund managers. In terms of the market share overall in Europe, the most mature market is the UK. We have almost 100% coverage over here in the UK. The mid-market is being served by private credit fund managers most of the time. We have a few smaller banks that do provide corporate financing also for the mid-market. However, most of the time also through their direct lending funds. And they have started to retreat as well recently from that space. So yeah, it's almost 100% covered by private credit. We have France and DACH, the German language regions, as the second and third largest market in Europe. We have coverage of 55 to 60%, which doesn't sound much, but it actually is. It is quite a lot, to be honest, because we have a very strong bank market still in France and in Germany or the DACH region. So 55 to 60% coverage by private credit is actually quite huge. And then we have Nordics and Benelux as really important and very attractive markets for the industry. Nearly 50% in some cases covered by private credit, and Spain and Italy up and coming, where we have 10, maybe 20% coverage, sometimes a little bit less, which doesn't sound much, but given that only a few years ago we had 95% coverage through banks, still that is actually quite a lot, to be completely honest. Now, how big is the European market? At the moment, we speak about 482 billion in assets under management, which is quite a lot. That's as of at the end of 2024. And according to Preqin data, the market is expected to grow to nearly $1 trillion by 2030. Given that this is in a relatively short time, it's actually quite huge. It's really growing and still very popular. And direct lending is still the #1 strategy over here. And it sounds all very big, but if you really look into it, the private credit part of things in European corporate lending is just about 1.6%. Not that much compared to the US market. So there is a lot of growth potential still in that space, and yeah, lots to come. Now, as I said before, 8-9 years ago, the market looked completely different to what it is today. In 2019, I witnessed one of the biggest deals at the time, Daisy Group. Ares Management would provide over £1 billion to support the founder in buying out another minority shareholder, over £1 billion in debt just for this one deal. Back then, it was a huge thing. There was a huge outcry from other fund managers who said, well, wait a minute, that's not direct lending anymore. That's way out of our league. And this is basically the BSL market. So what are you doing here? Now, fast forward 2026, this is peanuts. £1 billion for just one borrower, almost nothing. The market has changed dramatically, and it is changing still. And we will look into this for a little bit. We will see how the direct lending space and the BSL market is converging into one big mass of a capital market offering. Then the growth that has accelerated over the last few years, despite all of the crises that the market has faced. And there are a few new markets coming up within the space. We will look into the private credit CLOs for a little bit, what's happening there, private credit secondaries in the sense of continuation vehicles, etc. What's happening there. And we will look into asset-based finance for a little bit as well, because this is an up and coming part of the business as well. Now, what does belong into the private credit universe, especially over here in Europe? Well, when we look into those segments, the first thing that comes to mind and that we see is, as I said before, the direct lending space, which is the biggest space still. And this is where we see the convergence, of course, between the BSL and also the direct lending space. Asset-based finance is up and coming, especially with what is coming up now around Europe. We have an increased investment in infrastructure and defense by governments, for example. And there is a lot of opportunity for asset-based financing strategies to jump in and provide financing there. And as I said before, private credit secondaries, because LPs realize primary might not be the best option for us, but secondaries with a shorter duration, that might be even better for us. And so why not jumping into this? Now let's have a look into direct lending. What's actually the purpose of direct lending loans? Well, first of all, very classic, very plain vanilla, an LBO. This is how it all started, basically. So we have a private equity fund manager who decides to acquire a company. And instead of just using a lot of private equity financing, they decide to use some debt to support the deal. And that would usually be direct lending or private credit. Can also be TLB, depending on the borrower, but most of the time it would be private credit. Then plain vanilla M&A, of course. the borrower that was acquired by the private equity company would want to spread out a little bit, maybe into different markets, so they acquire another company, a competitor. Growth capital, organic growth, the borrower needs some financing for some sort of capex, etc. Recapitalization, the private equity sponsor wants to hand some sort of dividends to their shareholders, etc. So they would, of course, then recapitalize their borrower with the help of private credit and plain vanilla refinancings, which used to be the majority of all financing that we've seen over the last 3 years, maybe. So basically, it's maturing existing debt, some debt that was still in there provided by banks, needed to refinance, etc. So plain vanilla, basically. Now, how does it differ from the broadly syndicated market? Well, first of all, the type of borrowers. Sub-investment grade, we would see BB, CCC companies. Ticket size, usually, so core mid-market would be 10 to 300 million. This is where banks would usually not operate at all. And then the lenders, would be, of course, debt funds or club of debt funds, etc. In terms of leverage, I think this is really different compared to the broadly syndicated markets, 4.5 to 6 times, including junior debt. We would see 8, 10 times. I've seen 10 times. And in terms of structures, we usually have one unitranche that can comprise several facilities, but we have one unitranche, one lender, one borrower, and so nothing in between, so to speak. And of course, it's highly illiquid, as I said before. Now, where is the convergence happening with the syndicated market? Well, that is in the large cap space, where we have borrowers that are way larger than your 75 million EBITDA company, usually in the triple-digit million area in terms of EBITDA. And they require a lot more debt, way more than $1 billion, usually. And so this is where the actual competition between banks and also fund managers happens. One prominent example would be Adevinta, that was financed by a 4.5 billion private credit package. Several fund managers would provide the debt. Usually Adevinta, as a formally listed company, would go to the public markets, BSL or high yield bond market as well. But they decided to go into the private credit space. The terms, this is also where we see the convergence. Usually direct lending means kauf-lose, which means there need to be covenants, be it leverage covenants, interest rate covenants, or cash flow covenants. In the BSL market, it's kauf-light, and now we're seeing this as well in the direct lending space. Then we have a flow of financings. What I mean with this is basically we have some unitranches that are being refinanced with TLBs, and then we have some TLBs that are being refinanced with unitranches. Why does this happen? Well, usually if it's TLB to unitranche, it means it happens because the BSL market might be closed. The borrower needs more flexibility, or for whatever reason, they just prefer the private credit space because it's bilateral. The other way around, it's always the case that we have someone who wants to, how can I put this? Someone who basically wants a cheaper rate on things as well, because direct lending is indeed more expensive, on average 100 basis points. Meanwhile, and it used to be 250 to 300 basis points, etc. I don't want to go into details with the private credit documentation. You will all receive the slides anyway. I just want to give you a brief overview of what's in the private credit documentation as opposed to the BSL market, and where are the changes basically. And I want to point in that case into the portability aspect of things. Usually in private credit, we do not have portability, simply because if there is a change of control, which means the private equity sponsor sells their assets to another buyer, it means the change of control, and that would trigger the repayment of the private credit package. Used to be the case that this was always happening. Now, if you don't want to do that, you want to sell it, but you want to keep the private credit financing intact, you need to put in portability. And in the past, people would not really like that because you don't have control over who is going to buy the company. And that's usually not what you want as a lender. Now, let's have a quick look into the asset-based finance part of things. What is asset-based finance? It is, of course, an up-and-coming part of private credit. It's increasingly important, especially over the last 2 to 3 years. What comes to mind immediately, because you probably have heard about this, is NAV financing, net asset value financing. Now, this is, for example, when a private equity fund manager, for whatever reasons, sometimes the fundraising doesn't work as well as it should, or someone just needs some extra funding. You can get a NAV facility against your whole portfolio. That would be 20 to 30% against your portfolio, and then you can use the funding to clean up your portfolio, maybe do some add-on acquisitions, etc. A part of asset-based finance also is infrastructure debt, real assets of any kind, equipment financing, consumer assets, just like consumer receivables or mortgages, etc. Most of the larger fund managers, such as Ares or KKR, they do have an ABF strategy. Meanwhile, and recently CVC bought Marathon, which is a specialist in asset-based finance. So CVC apparently moves into this direction as well. Fairly new over here in Europe, as long established in the US, mid-market CLOs. Over here in Europe, it's relatively new because there are, of course, a few challenges. If you want to set up a private credit CLO, you might think it's must be the same as broadly syndicated loan CLO, but apparently it's not, because the BSL market is tradable. So it's fairly easy to manage BSL, CLO. You can buy, you can sell, you can rebalance the portfolio, etc. And private credit, it's not as easy. First of all the assets are really, really difficult to compare. Second of all, you need two rating agencies that rate your products. That can be a challenge. They kind of have to agree, of course, on the rating for the product. And yeah, there aren't that many assets, to be fair, over here in Europe that you can pool into such a product. But over the last few, let's say 18, 24 months, things have progressed. We've seen the first proper private credit CLO from Barings in 2024. And that was the starting point. The first one that was a static CLO, but counts as a proper CLO. And then in June 2025, we saw the first tradable one, which was launched by Ares, and Ares launched a few others. And there are quite a few coming to the market as well. Golub, for example, will move to the European market. They're very strong in the US, but are coming now to the European market as well. And Pemberton is also about to launch a product over here. Now let's have a look into private credit secondaries, which is actually quite interesting. And when I talk about private credit secondaries, apart from the CLOs that I just mentioned, what I found particularly interesting is that we are now seeing a lot more private credit continuation vehicles. Also long established in the US. Here in Europe, it's relatively new. Now, what we do know in Europe is the private equity continuation vehicle. Started many years ago, and it had kind of like a negative connotation because most people thought, oh, okay, the asset is not doing that well, so you just move it into another vehicle because you cannot, not really performing, doesn't grow. We cannot sell it. Nobody's out there to sell the asset, so we just move it. But after a while, actually, it's turned into a fairly decent tool to actually participate in a growth phase of an asset. Because let's face it, during the pandemic, we lost 2 years of growth, and people just wanted to catch up and start to think, let's move it into a continuation vehicle and see what happens. It has established since then, and now we see private credit fund managers doing the exact same thing. Now, what is the reason for this? Several reasons, of course. First of all, LPs get more flexibilities because LPs they just started to think we actually want to have a say in where to invest. And in the private primary space, it's just like you put in your capital. It's for long term, 5 to 7 years, and then you don't know where the money is being invested in. You don't know the borrowers, you don't know the opportunities. In the secondary space, there is an existing pool of assets. Maybe you like that asset, and you thought, I wish I could have invested in this specific credit 5 years ago. Couldn't. Now you can in the secondary market. And so you can participate in attractive um, credits. It has a shorter duration as well. So it's not your 5 to 7 years, it's maybe 3 years, maybe 5 years, something like that. And yeah, you know exactly what's in there. So you have full control over it. And so we will see a lot more of these vehicles coming up. And one of the biggest that has been launched this year was from Argmont, 2.7 billion euros. And those are assets from the vintage of 2019 that secondary investors can participate in. Now let's move to the fundraising part of private credit. As I said earlier, the market is growing. It's growing massively. And if you look into the look on at the chart that I'm presenting here, as you can see, North America and Europe combined, we see a massive inflow of capital. So apparently, LPs are still keen on providing capital to private credit funds. But what you can also see is that there are fewer funds that raise that massive capital. Only 31 funds in Europe and North America raised about 98 billion in the second quarter of this year. So as you can see, fewer funds, but a lot more of the capital combined. Why is that? Well, mainly because LPs are becoming more selective. They really want to make sure that they park their capital in the most successful fund managers and not some newly established fund managers or some sort of esoteric fund managers or strategies, etc. Now, in terms of strategies, what is still the most popular strategy is direct lending. And I'm pretty convinced that this will continue to be the most popular strategy because it's relatively simple. You have a senior secured loan that's being provided to a relatively decent borrower that is capable of repaying the interest, the financing at some point. So that's going to be always the most important selling point from my view. But you can also see that special situations, the more complex situations are gaining in popularity. And of course, distressed debt, mezzanine, which is the junior part of things, also quite popular. Now, what are the risks in the European private credit space? Well, first of all, credit and default risks, of course. You all have heard and read about the big disruption in the private credit space, mainly due to some sort of software exposure. I'm not going to go into details here because we just don't have the time. Just a few things about this, though. It happened mainly in the US. In Europe, it's slightly different, although there are some of the managers specializing in software. But I think the tools that are available over here in Europe are different and a little bit more suitable to manage the disruption. So yeah, default risks and credit risks will be the main risks here as well. Then, of course, macro and interest rate risks. Since all the facilities are based on floating rates, that means that interest rates going up will have a huge impact on the borrower's capability of serving the interest on the payments, etc. So this, of course, is a massive risk that you have to keep in mind. And then again, liquidity. Some people do not realize that the market is illiquid, and it's illiquid on purpose, right? It's for the longer term. And also valuation. There is no standard in valuation if it comes to private credit. So all the valuation that you can see in the portfolios is mainly based on internal models. In some cases, we have third parties providing some sort of valuation services, which is good. But it's really, really difficult to compare the portfolio of one fund manager with the portfolio of another fund manager, because it's a pool of bilateral contracts and nobody really knows what's in those bilateral contracts, to be fair. And then, of course, the regulatory and structural risk. Some central banks and also some regulators started to look into private credit, and they fear that there is some sort of systemic risk, mainly because there are banks out there providing leverage to fund managers just to boost the investable capital a little bit more. And although in Europe it's fairly decent, you have 1-1 leverage usually, compared to the US where you have an average 2-1. So it is still a certain degree of risk. Is it systemic or not? I personally believe it's not, but who knows for sure, right? So yeah, in a nutshell, we have a limited amount of time, and I hope I could give you a bit of an overview of what private credit is and where we're headed with this. If you have any questions, just let me know. I'm happy to answer. Apart from that, you will receive the slides. That's for sure. There's a recording as well. And yeah. Okay, thank you. There's a question regarding the UK market. What's the push behind UK banks retreating from the private debt markets? Is that purely regulatory or other factors? That's a very good question, actually. I think the main reason is indeed that given the risk profile, you have borrowers that are riskier than your average borrower, than your investment grade borrower. And at some point, the risk profile is just not confirming with the bank's risk profile overall. And that's one of the reasons. And then, of course, yes, regulators do push for banks really reducing the risk and cleaning out their balance sheet, etc. I hope that answers the question for a little bit. Any other questions? Another question I've found, what's the driver for the overall private credit fundraising growth? Oh, that's a better question. How large is the fraud risk around both the information relied upon for initial credit assessment and for collateral valuations, etc.? The fraud risk should not be that large, to be completely honest, because the due diligence process should include this specifically and should address this specifically. Now, we've seen that in coverage and media coverage that there were a few fraudulent processes. It happens from time to time, but it should not be the majority of all the cases should be relatively safe because the due diligence process is very, very intense, and there should be some sort of double checking in terms of where has the collateral been given, and where do we stand with this? So the how large is it? I cannot give you a percentage, but I can at least yeah give you a hint. I hope that helps for a little bit. Are you seeing widespread use of SRTs in this space? Yes, it's increasing. It is indeed increasing. It is relatively new still. There are not that many providers at the moment, but yes, we see an increase in that, and it adds, of course, a little bit to the complexity of the whole market as well. But it becomes more mature over the years, and so yeah, it is indeed increasing. Do you believe the due diligence collateral evaluations are consistently robust enough to cover that, though? There needs to be an improvement, that's for sure. I assume you refer to the fraud risk. Yes, there needs to be improvement. That's really the case. I think that in recent years, what we've seen is that some of the private credit providers have become a little bit sloppy, simply because, you had a lot of competition out there. You just wanted to get the deal done, and so you just agree on something, and due diligence is just like a model. I think this is changing, and yes, people have to start to do a proper due diligence process. Does it help with AI? Because I heard that some providers started to use AI for the due diligence processes. I think that will be an improvement. But yeah, I also know that the due diligence processes take longer, a lot longer than in the past, which is also improvement. But yeah, there's room to grow. There's room for even more improvement. And in terms of collateral valuations, I think people need to use a lot more of those third-party providers to simply do this. Because if you just rely on an Excel sheet with your valuation, I don't think that this is enough at this stage. People need to do a lot more, and they have to find the appropriate provider to do this. You said the number of funds has declined, yet continuation funds are being used more. Does the number of funds outstanding mask the extent of use of continuation funds? Well, when I say that the number of funds being raised, that is different compared to the continuation vehicles, because continuation vehicles are in the secondary space, which means that basically continuation vehicles do pool assets from existing funds and invite existing fund investors LPs to participate in this continuation vehicle. And then you have usually a bigger anchor investor. So I wouldn't say that it masks anything. All I can say about this is that basically the primary funds that raise the capitals, the number of those primary funds is indeed decreasing rather than increasing. And those bigger fund managers that do have successful fund vehicles in place, they see the opportunity to raise additional capital for a second or a different type of investor through the continuation vehicles. I think you have to be successful as a fund manager if you want to set up a continuation vehicle, because LPs nowadays, they've figured out that you cannot just pool any kind of assets and just put it in a continuation vehicle and come up with a story. You have to prove that those assets are really, really good, really well performing. And the discount shouldn't be too high. If it's a discount of 80 to 100, just, just put it into a distressed fund. But if you have a decent discount and you move it to a continuation vehicle for 98, 99, for example, from 100, that's quite decent. And investors will say, oh, that's actually good. I'm going to buy it. That's actually quite attractive for me, if that makes sense. Why would you want to create a continuation vehicle if you had good performing funds? Well, your fund reaches a maturity. So your fund vehicle usually lives for 7 years. And after the 7 years, per contract, you have to dissolve the fund vehicle, which means you have to sell all the assets, all the credits in that fund, and reimburse your LPs. They basically get out the returns on their investments plus their investments, and then you would start a new primary fund. Now, if you have really good performing assets, right, and you realize, I really, really want to stay in that asset. I do not want to sell it because I see that this is growing. So you have the opportunity to say, hey, you know what? There are certain assets that I really, really want to combine with assets from another fund. And then you move it into a continuation vehicle. And usually also your LPs, the existing LPs, they love to stick around and they love to invest in that pool of interesting assets as well, simply because they know it. They know that it is a good investment. They don't have to find anything else. And usually you find new investors as well who are keen to also invest and use the opportunity, if that makes sense. I think we're running out of time now. If there aren't any more questions, I would wrap it up.